starting with a new chapter called Corporate Valuation, Mergers and Acquisitions. Let us have understanding that say what are the learning points that we have say in this chapter. As what we can see, this chapter is basically divided into two parts. One is the corporate valuation and the next is the mergers and acquisitions. So let us have a conversation about the mergers and acquisitions and corporate restructuring. These are the three things that we are going to understand. In that, the term merger, the term acquisition, and the term corporate restructuring. These are the three terms that we have. Now listen carefully, a discussion about the same. Before I proceed further, I just would like you to tell me in the chat box that what is the objective of the financial management? Please write in the chat box. We understand that say the objective of the financial management is maximization of wealth of equity shareholders. This is the objective of the financial management. The objective is that say we should take any decision being finance manager of the organization in such a way so that it is able to increase, it is able to maximize wealth of equity shareholders. With that say we take all the decisions. Whether we are studying time value of money, whether we are studying cost of capital, capital structure theory, working capital management, derivative, foreign exchange risk management, you name anything in the financial management, ultimately all the efforts are going in one direction that we should be able to maximize wealth of the equity shareholders. I want somebody of you to write in the chat box that how do we measure wealth of equity shareholders. Friends, wealth of equity shareholder is measured in form of market price of equity share. We understand that so the current market price of the equity share is measuring wealth of equity shareholders. So every time, whatever the efforts that we are making is going again in one direction only, that we should be able to maximize wealth of the equity shareholder, which is measured in form of current market price of the equity share. Now, as far as the market price of the equity share is concerned, it is calculated by number of ways. And there are number of things which influence say the market price of the equity share calculation. I am focusing on one of the portion that we understand that say the earning of the company, there are a number of factors which are affecting say the market value of the equity shares. And one of the factor which is having an impact on the market price of the equity share is say the earning of the company. So we can say that say, as a company, as a finance manager, say you would like to increase your earning. There are number of organic ways by which say you increase your earning, and there are certain inorganic way. What we are discussing right now, say in terms of the merger, in terms of the acquisition, in terms of corporate restructuring, say it talks about certain inorganic way by which you will be able to increase your earning, and with that so you will be able to increase your market value. We understand that over here, say in the chapter of mergers and acquisitions, we are going to have understanding of the discussion of the acquisition only. There are hardly one or two questions that we have of the merger, and there are hardly one or two questions that we have of the corporate restructuring. Otherwise, basically the entire chapter is focusing only on one point, that is acquisition. So you can have some visualization like this. Let us say that there are that is two companies, A company and T company. For our discussion, A company is the acquiring company and T company is target company. That is the way there are two companies, acquiring company and target company. So most of the time we are going to have a decision making from acquiring company point of view, that whether the target company should be acquired or not, and if at all say we are going to acquire the target company, then what is the optimum price with which we should acquire the target company. From the target company point of view, similar there is a decision making. The decision making is that say, is it more profitable say to join any existing business, and whether we should be acquired by somebody else is better, then we carry on the business independently. That is what say the kind of decision making that say the target company finance manager is required to make. So over here say throughout the chapter we are going to have most of the time learning point from the acquiring company point of view, let's say whether we should acquire the target company or not, and from target company point of view say whether we should be like merged into a new entity or we should continue our business say separately. That is what say we are going to have the decision making. Dear students, as we understand, the term merger stands for there are two existing companies and it is getting merged in a new company. In terms of the acquisition, there are two existing companies and one of the existing company will acquire the running business of other existing company. And in case of the restructuring, the same company is being restructured. That is what we understand as the technical meaning of the mergers, acquisitions and corporate restructuring, and we are going to have discussion for most of the time for this point. Going further, as I told you, that say we have to keep in mind being finance manager of acquiring company, that say by taking this decision, will I be able to increase wealth of my shareholders? That is what you have to keep in your mind. Similarly, being finance manager of the target company, I have to keep in mind that say should I get merged into a new company or should I continue business independently? That is what I have to keep in my mind. Again, say I have to make sure that say I should be able to increase wealth of my equity shareholders. That is the way we are supposed to take a decision. Now friends, over here, listen carefully. We understand something like this. Let us say that say there are two companies in the market of manufacturing mobile phone. In the market of manufacturing mobile phone, there are two companies in the market, acquiring company, target company, and at the same time, say number of other companies are also there in the market. Let us say that say whatever the overall market which is there for the mobile phone handset, of that, let us say approximately 40% of the market is captured by A company, 25% market is captured by B company, and so the remaining 35% share is say of other number of companies. Now in this case, what will happen? Acquiring company may consider to acquire the target company so that say as a merged entity, they will be able to get more market size. In a way that say we understand that's the best aspect of the acquiring company and target company can be merged, and with that so the merged entity can do business, that is acquiring company can do business, and as a merged entity they may be able to have the market share which is greater than 65%. This is the intention that the acquiring company may have for acquisition. Second, we understand that say there may be acquisition with the purpose, that is say in this situation as a merged entity what will happen, say number of common expenses say can be curtailed. Number of common expenses can be reduced. Third, we understand that say the first number company is A Limited, second is T Limited, and there are a number of other miscellaneous companies. Now, if at all these two giant companies merge, then in that case, so there will be at least for certain time period a kind of monopoly situation. So what will happen? They will be able to charge premium from the customer. Earlier, what may happen? Earlier, we understand that so the acquiring company, whenever it was say going to introduce anything in the market, it always had a fear, say keeping high price. Why? Because A Limited had a fear that so the T Limited will introduce certain products, say which will be very similar to this say at competitive price. So it was not able to charge premium from the customers, but now they know that so the next best company is say far behind them. So they will be able to charge premium from the customers. Then we understand that say these two companies were having so the huge advertisement expenses just to compete with one another. But now say that threat is not there for the merged entity. That is the reason so the advertisement expenses will be reduced once again. So we can say that say if at all the two companies which are belonging to the same line of the business, if at all they merge, then in that case one or more of such advantages will be there. Because of these advantages, so the earning of the company increases and present value of the same is going to increase the value of the merged entity. So what will happen? Whatever is the value of the A plus value of the T in comparison to them, the value of the merged entity would be higher. So whatever the incremental value that say these companies are able to generate, so that can be shared between both the companies in certain proportion. And this is the way say they will be able to get the advantage. And this is what we are going to have understanding over here say in this chapter. Next, we understand something like this, that number of times say there may be a cash rich company which wants to enter into new line of business. Let us say that say the Infosys has done great in the IT sector. Now say it wants to enter into, let us say that's the hospitality sector, and it wants to make investment in the hotel end of the business. We understand that say if at all you want to establish hotels, then in that case first of all you're required to properly search the location where it should be located. You have to obtain proper licenses, then you're required to appoint the proper staff, and with that so you'll be able to reach to a point where you will be able to do a business. So that is step number 1, step number 2, step number 3, step number 4, step number 5, and then you will be able to start the business. What Infosys may think that say doing all this will take time. So instead of going like this step 1 to step 5, let me acquire say an existing chain of the hotels. So what I will be able to have, I will be able to get the like ready-made infrastructure